How Warren Buffett made his fortune. Many people believe that wealth comes quickly, often through bold, risky moves. The idea of striking it big in a short time is common, and yet for most it leads to frustration and failure. Warren Buffett, however, took a different route. He understood that real wealth is built slowly and with purpose. His fortune wasn't created through bursts of luck, but through careful, patient decisions. In this video, we'll explore how this steady approach made Buffett one of the wealthiest individuals in the world. Number 1, the cigar butt versus wonderful business pivot. In his early years, Warren Buffett invested in what he called cigar butts, companies that were cheap, often failing, but still offered some value, like the last puff of a used cigar. It was a strategy that, at the time, seemed logical. But over time, he realized something profound, that real wealth isn't built on cheap, fleeting opportunities, but on investing in wonderful businesses, companies with strong, sustainable growth and lasting value. The shift from the cigar butt to wonderful business approach was not just an investment strategy, it was a mindset change. Instead of focusing on low price and short-term gain, Buffett began prioritizing businesses that could thrive independently, that would continue to grow regardless of market fluctuations. This pivot was crucial in shaping his long-term success. Buffett's wisdom here is simple but profound. Seek out businesses that have a competitive advantage, that will continue to build and grow over time. Quality, it turns out, matters far more than the price. Number 2, exploiting the cash flow versus earnings disconnect. Most people focus on a company's earnings, what they see on the financial statement as profit. Earnings are an important figure, but they can be misleading. The truth is, earnings don't always reflect the real financial health of a business. This is where Warren Buffett's insight became crucial. He always paid more attention to cash flow than earnings. Cash flow is the actual money a company generates, the cash it can reinvest, pay down debt, or use to fund future growth. Earnings, on the other hand, can be influenced by accounting decisions and can sometimes paint a misleading picture. A company might report strong earnings, but if its cash flow is weak, it's a sign that it may struggle in the future. Buffett understood this early on. He looked beyond the surface, recognizing that a business's true strength lies not in its reported profits, but in its ability to generate consistent cash flow. It's like looking at a tree's roots to see how deeply it's grounded, rather than just admiring its leaves. This focus on cash flow allowed Buffett to make investments that had real staying power, providing him with the confidence to hold those investments for decades. When you understand the difference, you begin to see past short-term earnings and focus on what really matters, the sustainable, growing cash flow that ensures long-term success. Number 3, the Geico key. Float as a free weapon. One of Warren Buffett's most brilliant moves was acquiring Geico, and in doing so, he unlocked a powerful concept that few people fully understand: float. Float is the money that insurance companies hold temporarily before paying out claims. It's money that isn't theirs to keep, yet they can use it freely in the meantime. And for Buffett, float became a weapon, a free weapon. Think about it this way: when an insurance company collects premiums, it doesn't need to pay claims right away. That means they can invest this money and generate returns before having to pay out any of it. It's like having access to someone else's money without the burden of paying it back for years, allowing you to invest and grow your wealth at no immediate cost. Buffett saw the potential of float early on. Rather than simply using it to run Geico as an insurance company, he used it as a source of capital for other investments. It gave him a unique advantage: access to cheap, flexible capital that didn't come with the same risks or limitations that borrowing money might. This insight is invaluable. Float isn't just something insurance companies benefit from. It's a powerful resource that, when used wisely, can accelerate wealth creation. It's a reminder that some of the best financial opportunities are those that others overlook, simply because they don't understand how to leverage them. By understanding the value of float, Buffett was able to build his empire with the kind of leverage few investors ever get to tap into. This principle isn't just for insurance companies. Understanding how to use float can unlock opportunities for anyone. It's a quiet, powerful tool for long-term wealth. Number 4, psychological arbitrage on market panic. When the market panics, most people sell. The news is filled with fear, uncertainty, and chaos, and in those moments, people often make decisions based on emotion rather than logic. But Warren Buffett understood something fundamental. When others panic, that's when the real opportunities appear. This concept, known as psychological arbitrage, is about taking advantage of the emotional mispricing that occurs during times of market turmoil. When investors are afraid and start selling their assets, the value of quality companies can drop far below their true worth. The market, in its panic, tends to overreact, creating opportunities for those who can keep their calm. Buffett's approach during market crises is always the same. He buys. While others are driven by fear, Buffett is driven by a clear understanding that the market's emotional response doesn't change the fundamental value of good companies. It's like a well-built house that's suddenly being sold at a fraction of its worth because everyone's focused on a storm approaching. The real understanding here is simple, but profound. Wealth isn't just about reacting to the market, it's about understanding that in moments of panic, the market often gets it wrong. The best investors can see the difference between a company's actual value and what others are willing to sell it for in the heat of the moment. By mastering psychological arbitrage, Buffett doesn't just avoid losing money during crashes. He gains. He capitalizes on other people's fear, buying at prices that no one would consider rational during calm times. And this consistent ability to take a contrarian, reasoned approach during times of uncertainty has been key to his enduring success. So, the next time the market faces a crisis, instead of following the crowd, ask yourself, is this really a moment of danger or a rare opportunity disguised as fear? Number 5, building a moat, not just picking a stock. When most people think about investing, they focus on the stock itself, the ticker symbol, the price, the short-term performance. They chase trends, hoping to pick the right stock at the right time. But Warren Buffett taught us that investing isn't just about picking stocks. It's about building a moat around the business itself. A moat is the competitive advantage that protects a company from its competitors. It could be a strong brand, proprietary technology, or a dominant market position. Buffett knew that companies with a strong moat can fend off competition, maintain consistent profits, and continue to grow, even when the market or industry faces challenges. The key insight here is that a moat is the real value of a business. If a company has a wide moat, it's like a castle surrounded by a deep, wide river. No one can easily cross and take its place. Without a moat, even the best stock can be overtaken by competition, leaving investors vulnerable. Buffett didn't just pick stocks based on short-term opportunities. He looked for businesses that were hard to replicate, companies that had built something sustainable and valuable over time. He invested in businesses that, even if the market fluctuated or the economy shifted, would continue to thrive because of their inherent strength. For Buffett, investing in a company with a moat isn't about finding the next hot stock. It's about finding a company that will continue to thrive and grow for years, even decades. That's the kind of investment that can build real wealth. So when you invest, ask yourself, is this company protected? Does it have a moat? Or is it just a stock vulnerable to competition and market whims? Building a moat is a long-term strategy that secures wealth, not just a one-time gain. Number 6, the compounder's diet. Relentless reinvestment, not dividends. When most investors think about returns, they often focus on dividends, the cash that companies distribute to shareholders. Dividends can feel like an immediate reward, a tangible sign of profit. But for Warren Buffett, the true wealth-building power lies not in receiving dividends, but in companies that reinvest their earnings back into the business. This reinvestment fuels growth, compounding wealth over time. Buffett's strategy is simple. He seeks companies that use their profits to expand, innovate, and strengthen their position in the market, rather than paying those profits out to shareholders. It's a philosophy rooted in the power of compounding. Compounding doesn't just apply to interest rates, it applies to business growth. When a company reinvests its profits into projects that generate more profits, those earnings start to snowball. Over time, this creates a steady exponential increase in value, far beyond what dividends alone could provide. Think of compounding like planting seeds in rich soil. The more you reinvest, the more the tree grows, year after year. If you take the fruit off the tree and stop planting more seeds, the growth slows. But if you continue reinvesting, the tree becomes stronger and more fruitful each year. This is how Buffett's wealth has grown, through the steady, relentless reinvestment of profits into companies that will compound over time. The common misunderstanding is that dividends are the quickest way to get rich. But Buffett's approach reveals a deeper truth. The real power lies in long-term reinvestment, in watching your money grow slowly but steadily with the patience to see it flourish. While dividends provide short-term gratification, compounding rewards those who understand the value of waiting and reinvesting. By adopting the compounder's diet, the relentless reinvestment of earnings, you begin to see that wealth isn't built on immediate payouts, but on the quiet growth of something much larger over time. Reinvesting isn't just about money, it's a mindset that understands how wealth compounds and thrives, slowly but surely. So ask yourself, are you chasing quick dividends, or are you building something that will grow exponentially over time? Reinvestment is the real key to compounding wealth. Bonus point: buy when headlines cause panic selling. In moments of market crisis, the headlines are filled with fear. The news screams of impending doom, the economy in free fall, and disaster lurking around every corner. It's during these times that most investors make their biggest mistake. They sell. They react to the panic as if the world is ending, and they retreat, often at the very worst moment. But this is precisely when Warren Buffett sees opportunity. Buffett has always been able to separate the emotional noise from the real value of a business. While the market is in turmoil, the fundamental strength of good companies doesn't vanish. What's really happening is that fear is causing people to sell off quality businesses at a discount. This is the moment when Buffett steps in, buying companies at prices far below their true worth. Buffett's approach here is based on understanding that panic creates opportunities for those who can think clearly. When the media stirs fear, investors tend to overreact, driving prices down beyond reason. For Buffett, this is psychological arbitrage, taking advantage of an emotional mispricing by the market. When everyone else is selling out of fear, he's buying with the clarity of long-term value in mind. The real insight is that market panic doesn't always reflect the actual state of businesses. It reflects the collective emotional response of the market. The ability to buy when headlines create fear requires emotional discipline, and it requires a deep understanding that often the best opportunities arise when others are most afraid. So when the news gets loud and the panic sets in, ask yourself, is this moment a true reflection of reality or just an emotional overreaction? Buying when others are selling can transform fear into fortune. Bringing it all together today, we've explored the quiet yet profound strategies that have shaped Warren Buffett's extraordinary fortune. From the patience needed to shift from cigar butts to wonderful businesses, to the power of understanding cash flow over earnings, we've learned how to leverage these principles for long-term success. We've seen how float can be used as a free weapon and how to capitalize on market panic with calm, reasoned decisions. And ultimately, we've learned that building a moat around a business is far more important than just picking a stock. Now, take a moment to reflect. Which of these principles resonated with you the most? Was it the power of reinvestment or the discipline to stay calm during times of market fear? Leave a comment below and share your thoughts. If you found these insights valuable, please like the video. It helps more people discover thoughtful content like this. And if you haven't already, subscribe to dive deeper into these timeless principles of wealth building. Our next video will continue to unpack the wisdom that leads to lasting financial success. As you move forward, think about your own financial journey. How can you apply Buffett's principles in your life, not just for wealth, but for clarity, discipline, and long-term growth? Your journey doesn't have to be rushed. It just needs the right foundation. Thank you for watching.